It's already happened once. The gold-silver ratio didn't briefly dip below 50 in late January because of a single trader's positioning. The ratio didn't compress from 62 to 55 in 1 week in early May because of a tariff truce announcement. And silver didn't surge 7% in a single session, while gold barely moved because retail piled in at the wrong moment. The ratio is doing what the ratio always does at the early stages of a sustained metals bull market. Silver is starting to outpace gold, not by a little, not occasionally. Structurally, on every meaningful relative strength measure, silver has been gaining ground on gold for over a year now, from 88.1 in early 2024 to a brief print below 50 in late January 2026 to today's reading around 55. The trajectory is unambiguous. The mechanism is documented across every prior silver bull market in modern history. And the institutional consensus is finally beginning to acknowledge what the chart has been signaling for 15 months. Bank of America's bull case at $135,309. Citi's stress target at $150, $170. UBS's year-end forecast at $100. JP Morgan at $81. The bull range from credentialed analysts has widened to include numbers that would have been considered fringe 2 years ago. And those numbers all share one underlying assumption, that the gold-silver ratio continues to compress as the metals bull market matures. Silver doesn't just rise, silver leaves gold behind. Welcome back to the Macro Mirror. In this breakdown, I'm going to walk you through exactly what the gold-silver ratio is measuring, why the 51 level matters more than any single price target, and what the late January break below 50 actually told the market. I'm going to show you the historical pattern at every major silver bull market peak. 1980 at 17.1, 2011 at 31.1, today at 55, and what each of those compressions implied for absolute silver prices. I'm going to give you the structural mechanism that drives ratio compression during sustained bull markets, and the bear case that says this compression cycle may be different. And I'm going to give you the 4 signals that will tell you whether silver continues leading or whether gold reasserts dominance. Quick favor before we go further, subscribe. If you want clean breakdowns of cross-asset structural moves when they actually matter, not hype, not cheerleading, just the mechanics, hit the bell. Ratio compressions don't announce themselves through press releases. They announce themselves through silver leading days the financial press underreports. Let's get into it. Let me start with the numbers. Because the gold-silver ratio has a vocabulary that almost everyone in retail finance uses incorrectly. The gold-silver ratio is calculated by dividing the gold price by the silver price. As of mid-May 2026, with gold trading near $4,700 and silver near $85, the ratio sits at approximately 55. That figure is the most important single number in cross-metal analysis, and it has a specific historical context that determines what it means. The 50-year average gold-silver ratio is approximately 60.1. The typical range is 40.1 to 80.1. Below 40, silver has historically been expensive relative to gold. Above 80, silver has historically been cheap. The ratio has spent most of the past quarter century elevated, averaging closer to 60-65.1 since 2000, reflecting silver's persistent underperformance relative to its monetary history, when the ratio exceeded 100.1 during the COVID crash of 2020, peaking at 125.1, that represented the most extreme silver undervaluation in modern market history. Anyone who bought silver at that 125.1 ratio into the deflationary panic has roughly tripled their position relative to gold over the following 6 years. What's happening now is the unwind of that extreme historical undervaluation. The ratio at 88.1 in early 2024 represented persistent silver weakness. The compression to 55 by mid-May 2026 represents a roughly 38% improvement in silver's relative value over 15 months. And the brief dip below 50 in late January when silver topped $121 represented the first sub-50 ratio reading since 2012, a 14-year structural threshold being breached for the first time since the previous bull market peak. So here's the first lesson. The gold-silver ratio isn't a price target. It's a measurement of where the metals stand relative to each other and to their own historical extremes. When the ratio compresses sustainably below the long-term average and stays there for extended periods, it signals one specific thing. Silver is in a leadership phase within a precious metals bull market. That phase has historically produced silver returns that dwarf gold returns over the same window. The 55 reading isn't dramatic in isolation. The trajectory from 88 to 55 with a sub-50 print mid-cycle is the signature of the structural shift the chart has been signaling since early 2024. Let me get more concrete about why the 50.01 level specifically matters. Because below 50 isn't just a round number. Picture an institutional commodity trader at a London desk. Tuesday morning, January 28th, 2026, 8:47 a.m. London time. Silver is trading at $118 and gold at $5,580. He pulls up the ratio on his terminal, 47.3.1, below 50 for the first time in nearly 14 years. He has been watching this level for months, not because the number itself is magic, but because every previous breach of 50.1 in modern market history has marked a specific point in the silver bull cycle. He's seen this movie before. He pulls up the historical chart. 2011 silver peak, ratio compressed to 31.1 at the top. 1980 silver peak, ratio compressed to 17.1 at the top. Both prior major silver tops featured ratio compressions far beyond where the current reading sits. The 47.3 he's looking at this morning isn't the destination. It's the early signal that the destination might be considerably lower. He runs the math on what 31.1 would mean today. At gold's current 580, a 31.1 ratio implies silver at $180. He runs 17.1, though he doesn't really believe that's the path. 328. He runs a more conservative 41, closer to the long-term average. $140. None of these numbers are on the institutional forecast consensus, but the ratio math produces them as natural targets if the historical pattern repeats. He files a note to his risk committee. Subject line, ratio compression, early signal. He doesn't put a specific price target on it. He recommends maintaining the silver overweight position. He flags the risk that the compression could pause or reverse if gold pulls back, but argues the structural setup remains intact regardless of near-term price action. That memo isn't unique. Versions of it are circulating across every commodities research desk that takes silver seriously. The ratio at 47 was the alarm. The pullback back above 50 to today's 55 is the consolidation. The next leg, if it follows historical patterns, takes the ratio meaningfully below 50 again, this time on sustained basis rather than a one-day touch. So here's the second lesson. The 51 level isn't a price target. It's a psychological and historical threshold that, once breached durably, signals silver leadership in the metals bull market. The January touch was the test. The current 55 reading is the consolidation. The next test, whether it comes in June, July, or later in 2026, determines whether silver actually decouples from gold or whether the current pattern fails into another cyclical pause. Let me put the historical pattern under a microscope. Because the ratio has compressed dramatically at every major silver bull market peak, and the pattern is specific. In January 1980, the gold-silver ratio compressed to 17.1 at the peak of the Hunt Brothers silver run. Silver was at $49.45. Gold was at $850. That 17.1 reading was the lowest in modern monetary history outside of brief technical anomalies. The ratio reached that level because silver had been suppressed at $46 for most of the 1970s, while gold ran from $35 to $850. When silver finally caught up, the compression was violent. Silver gained 100% in 1979, 1980 alone. Gold gained 200% in the same window. The ratio compression measured silver's catch-up trade in real time. In April 2011, the gold-silver ratio compressed to 31.1 at the silver peak. Silver hit $49.20. Gold was at $198.20. The 31.1 reading came at the end of a multi-year run during which silver had outperformed gold by approximately 4-1. Industrial demand from emerging market electronics, photovoltaics, and post-financial crisis money expansion had driven silver from the mid-teens to nearly $50 inside of 3 years. The ratio compression captured silver's outperformance precisely. Anyone who held silver instead of gold during 2008-2011, when the ratio went from approximately 80.1 to 31.1, captured significantly more upside per dollar invested. In 2020-2021, the ratio compressed from a peak of 125.1 during the COVID crash to approximately 64.1 by August 2020. Silver more than doubled in 5 months, while gold gained roughly 30%. The compression was the signature of silver's industrial catch-up trade as deflationary fears gave way to monetary expansion. The cycle didn't run to traditional bull market lows on the ratio, but the directional move captured the standard pattern. Now, the current cycle. The ratio sat at 88.1 in early 2024. It compressed to 55 by April 2025. It went to a sub-50 print in January 2026 at silver's all-time high of $121.64. It expanded back to the low 60s during the spring correction. It recompressed to 55 by mid-May. The path is jagged, but the direction is unambiguous. If the historical pattern repeats, and there's no structural reason to expect it won't, the next leg takes the ratio toward the 40s, then potentially toward the 31 to 37 range that prior major bull market peaks have produced. What does that mean in absolute silver terms? If gold reaches $6,300, which is JP Morgan's year-end target, and the ratio compresses to 40.1, silver mathematically reaches $158. If gold reaches $7,000, which several institutional macro strategists target, and the ratio compresses to 35.1, silver reaches $200. If gold reaches the $8,500 level Michael Oliver's framework implies, and the ratio compresses to the historical bull market norm of 31.1, silver reaches $274. None of these numbers require speculative assumptions. They're the mechanical output of historical ratio behavior applied to current institutional gold targets. Is the historical pattern guaranteed to repeat? No. Each bull cycle has unique characteristics. The 1980 compression was driven by a corner attempt that ended through exchange rule changes. The 2011 compression was driven by post-crisis monetary expansion that has since been substantially absorbed. The current cycle has different drivers: structural deficit, Chinese export restrictions, AI-driven industrial demand, sovereign reserve repositioning. Whether those drivers produce the same magnitude of ratio compression is the open question. What's not arguable is that the historical pattern exists. The current trajectory matches the early stages of prior compressions, and the institutional analysts running these models are positioning accordingly, even if they're not publicly forecasting the resulting price levels. Let me give you the bear case fairly, because intellectual honesty separates this analysis from the noise. The bear case against continued ratio compression rests on several real possibilities. Industrial substitution risk is real. Longy Green Energy's copper-based solar cells, semi-solid batteries that don't require silver, ongoing thrifting of silver content in photovoltaic manufacturing. If industrial demand stalls or contracts, silver's outperformance driver weakens, and the ratio could expand back towards 70 or 80. The 2024-2026 compression cycle has already done substantial work. Silver has gained roughly 200% from late 2023 lows, while gold has gained roughly 160%. Some of the catch-up trade is already in the price. UBS recently cut its year-end silver target to $80 from higher levels, citing demand destruction concerns. The most bearish institutional voices remain at the $44-70 range. These are real arguments. The technical chart shows silver having repeatedly tested $80 as resistance and failed, with a 50-day moving average actively capping rallies. A weekly close below $75 would invalidate much of the bull thesis. Industrial substitution is a slow-moving but genuine threat to silver's long-term demand structure. What the bear case doesn't disprove is the historical ratio pattern. Even if industrial demand softens modestly, silver retains its monetary metal status, and the ratio at sub-50 readings has historically required substantial absolute silver appreciation. The compression can stall, but the underlying structural setup, gold's continued accumulation by central banks, the silver deficit in its 6th year, the broken arbitrage between Western paper and Asian physical, doesn't reverse easily. The ratio's trajectory may pause. The direction of pressure remains downward. So ask yourself, when the ratio is compressed from 88 to 55 over 15 months, when it briefly touched 47 in late January at the silver peak, when historical bull market compressions reached 1737 levels at major tops, when current institutional gold targets imply silver prices well above current spot if historical ratios apply, and when the structural drivers, deficit, fragmented markets, sovereign accumulation, are intact, what does the current 55-1 reading represent? An interim resting point or fair value? Now let's read the current action like a forensic report. The forensic case for continued silver leadership is built on signals that are converging in the same direction. The May 11th ratio compression from 62 to 55 in a single week was driven entirely by silver. Gold barely moved. That split confirms silver responding to industrial demand catalysts independently of gold, which is the structural signature of a metal entering its leadership phase. The Bank of Korea's Q1 2026 entry into gold reserves, the Tanzania and Uganda domestic gold programs, and the continued People's Bank of China accumulation all support gold's structural floor, meaning gold is unlikely to retreat substantially even if silver pauses. That means ratio compression doesn't require gold weakness. It requires silver strength, which is what the current setup produces. You would also expect, in a market where ratio compression had completed, for institutional research desks to be flagging silver as overbought relative to gold. The opposite is happening. Bank of America's $135,300 bull case explicitly uses ratio compression as the price target derivation. Citi's stress targets at $150, $170 imply ratio compression to 30 to 34 if gold stays at current levels. The bull side institutional consensus is now built on the assumption that the ratio continues to fall. The bearish side argues primarily that gold falls, not that silver fails to gain on gold. So here's the cliffhanger. The 51 level is the early threshold. The historical bull market troughs are 31, 17, and 47 across the last 3 cycles. The current cycle has touched 47 once. The question is not whether the ratio breaks below 50 again. The question is how far below 50 it goes when it breaks, and whether that compression happens through silver rising to 100 plus or through gold falling. The structural setup, fiscal dominance, sovereign accumulation, Fed paralysis, industrial demand growth, argues for silver rising rather than gold falling. The math then produces price targets that almost no mainstream analyst will publish directly. Let me put the macro context around it, because the ratio doesn't move in isolation. Gold is at approximately $4,794. The Federal Reserve voted 8-4 on April 29th with 4 direction descents. Kevin Warsh confirmed under partisan vote, sworn in mid-May. The June 16th to 17 FOMC dot plot is the next major data point. April CPI came in at 3.8%, above forecast. The fiscal deficit is $2.65 trillion. The Iran conflict remains unresolved. Section 122 tariffs expire July 24th. Central bank gold buying at structural 850-ton pace. COMEX silver inventory at 79.88 million ounces, 13.4% coverage. The 1971 monetary regime parallel I covered in detail in last week's video. Every one of these factors compounds the case for continued ratio compression. Monetary regime stress drives both metals higher, but silver historically amplifies gold's moves by 2-3x during real yield compression cycles. The 2019-2020 easing sent silver from $14 to $29, while gold went $100 to $2,000. The 2025 easing sent silver from $29 to $121, while gold went $2,800 to $5,600. Each cycle, silver outperformed gold by approximately 2 to 3x. The pattern is the ratio compression in motion. Here are the 4 signals that matter more than any forecast you'll read this week. 1. Ratio reading on a sustained basis, currently 55. Watch for a sustained close below 50. Not a single day spike, but a weekly close. That would confirm the late January sub 50 touch wasn't an anomaly. A sustained break below 50 historically precedes the most aggressive phase of silver bull markets by 6 to 12 months. 2. Silver only price action on gold flat days. The May 11th single session move where silver gained 7% while gold barely moved was the cleanest possible signal of silver's independent leadership. Watch for repeated instances. If silver continues to gain on days when gold is flat or down, the ratio compression is structural rather than tactical. 3. Mining stock leadership within the metals complex. Silver mining ETFs outperforming both gold spot and gold miners is the cleanest signal of institutional positioning. The Q1 2026 outperformance of silver miners over GDX confirmed this pattern. Continued outperformance through Q2 would extend the signal. 4. June 16th to 17 FOMC dot plot, the first under Warsh. If the dot plot shifts dovish on real yield grounds despite hot CPI, the ratio compression accelerates as silver amplifies the gold move. If the dot plot stays hawkish, the compression may pause, but the structural setup remains. Now I'm going to ask you 2 questions, and I want your honest answer in the comments. First, pick a ratio reading for December 31st, 2026. Commit to a specific number. 45? 40? 35? Or do you think the compression reverses and the ratio expands back to 70? Drop your number. Drop your reasoning. Don't hedge. Second, of the 4 signals, sustained sub 50 ratio, silver only price action on gold flat days, mining stock leadership, or June dot plot, which one would most clearly confirm that the compression has entered its acceleration phase rather than its consolidation phase? This question requires real thought because the answer determines what you should watch over the next 90 days. Now, what should you expect next? Expect volatility. Ratio compressions don't move in straight lines. The ratio could expand back to 60 if gold rallies harder than silver in a near-term flight to safety. The ratio could compress to 48 quickly if silver breaks above $94 while gold consolidates. The path is nonlinear. Expect mainstream financial media to continue treating the ratio as a curiosity rather than a structural signal. The narrative will lag the chart by quarters. By the time the financial press acknowledges that silver entered a leadership phase, the ratio will be below 40. And expect opportunity to appear in periods when the ratio briefly expands rather than compresses. The compression to 55 is the consensus reading. The expansion back to 62 or higher, and when it happens, is the moment to add silver exposure if the structural thesis is intact. Counter-trend windows in structural bull markets are where positions get built. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what the gold-silver ratio is actually telling you right now. The ratio is at 55. It briefly touched 47 in late January. It compressed from 88 in early 2024. The pattern matches the early stages of every prior major silver bull market. The historical compressions at peaks have ranged from 17 to 37. The institutional gold targets, JP Morgan at $6,300, Michael Oliver's framework at $8,500, imply silver prices well above current spot if historical ratios apply. Amateurs watch one metal at a time. Pros watch the ratio because it captures the entire metals complex in a single number. The amateur tape says gold and silver are both consolidating. The professional tape says silver is decoupling from gold in a pattern that has produced every major silver bull market in modern history. Silver has been monetary metal for 5,000 years. The gold-silver ratio has measured their relative value across centuries. The compression from 80 to 100 readings to sub-50 readings has marked the leadership phase of every silver bull cycle in modern history. The current reading sits at 55. The trajectory is downward. The structural drivers, fiscal dominance, sovereign accumulation, deficit, fragmented physical markets, industrial demand, are intact. The pattern is reassembling. So here's the clean summary. The gold-silver ratio is at 55. It compressed from 88 in early 2024 to a sub-50 touch in late January 2026. The May 11th compression from 62 to 55 in a single week was driven entirely by silver. Historical bull market peaks featured ratios of 17.1, 1980, 31.1, 2011, and 47.1, January 2026 brief touch. Current institutional gold targets imply silver prices of $158 to $274 if historical ratios apply. The structural drivers are intact. The Fed trap continues. Central bank gold accumulation continues. The silver deficit is in its 6th year. The mainstream financial press is calling the ratio consolidating. The chart is calling it the early stage of a leadership phase. This is where the serious holders of monetary assets separate from the tourists. The tourists watch one metal. The serious holders watch the ratio. If you want the next breakdown, the moment the ratio breaks below 50 on sustained basis, the moment silver decouples on a gold flat day, the moment the June dot plot lands, the moment the compression converts from consolidation to acceleration, subscribe. These shifts don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the move before the headlines do. Drop your December 31 ratio target in the comments. Tell me which signal you'd watch most closely, and I'll see you in the next one.